So welcome everybody to Search Funder's session on the basics of business valuation. I am really looking forward to this session because I know that I will learn a lot. I took finance in business school and I promptly forgot it as soon as I left. So I'm happy to have Amy LaSala from Blue Sky Business Resources with us. She is their VP of Operations, working with clients as well on their financial valuations. We were talking just before we got started about the fact that she's been a Girl Scout leader for 8 years. And so I figure if you can wrestle a bunch of Girl Scouts into orderliness, you can do just about anything you put your mind to it, Amy. So welcome aboard, Amy. What I'd like to do is make sure that you can share your presentation. Our agenda for today will be that Amy's going to present some case studies for us, and then I may ask a few questions, and you will have the opportunity to ask questions as well.
All right. Well, thank you for having me. First of all, I'm really excited. We have a great turnout today. So my agenda for what I'm going to go through today is I'm going to walk through different parts of the valuation, things that when you guys are evaluating potential companies to buy, risks, other things you should be looking for. And then we'll talk about how to answer some of these questions, because at the point when you're trying to do your calculations, sometimes you don't have access to all of that at that point. As she mentioned, I am the VP of Ops at Blue Sky. Blue Sky is an M&A consultancy firm. We do everything from helping businesses at the startup phase all the way through exiting. So we can help a business at any stage in that life cycle. And what I mainly focus on are doing the business valuations for our clients. I get the fun job, though, that I get to see pretty much everything that we do go through the process. So I have a lot of different experience. A lot of it is more on the sell side, but I am absolutely familiar with buy side as well. Okay, so different parts of the valuation that we should be seeing if you're having someone do it for you, but also then things that you want to be evaluating yourself. So normalizing the financials, doing an industry review, benchmarking your company after you have those financials normalized against industry. Comps analysis, we can look at different comps, public and private, depending on the type of company that you're looking at. And then what is that fair market value? Not all valuators or valuations are created equal. Some of them may not go as deep into the valuation and do a more kind of desktop review of just the financials, and they're not asking further questions about management team and things like that. So that's why I'm going to go through all of these and hit on when you hire someone to do one for you, you want to see that they are actually looking past just the financials. Okay, so first of all, and probably one of the things you all are aware of is normalizing the P&L. So the P&L is probably one of the easiest things to look at. And we're trying to get to that normalized EBITDA number so that when we're looking at comps and benchmarking, we're actually comparing apples to apples. If you don't normalize either the P&L or the balance sheet, you're not getting that true comparison when you're looking at like an RMA statistic for, let's say, days receivables. Some of the things that get taken out of the P&L when you're normalizing them. We're looking at management discretionary expenses. So cell phones, children's tuition, a boat they may have, they're paying a boat payment. You name it under the sun, I have seen it. We've seen a train in there. We've seen yachts, houses in the Bahamas. I mean, some of this stuff gets crazy. And they are hidden in the P&L. It's not like you're going to have a line item that says owner's ridiculous expenses. That shouldn't be here. So this is where, you need to ask these questions. Typically, when you get financials from a company, if they are working with an advisor, you are going to get a normalized P&L from what they're deeming appropriate add backs. I, again, have seen where we had a client told me he had $500,000 in personal expenses each year. And I was like, holy cow, I need some receipts for that. I need backup documentation, because if I show that to a buyer and he was doing about 5 million in sales. And so as a personal expense, 500,000, that's a lot. He produced about 250,000 in receipts. The rest he then told me he took out as cash. Well, cash I can't add back. You should have booked that as revenue and taken it out as a distribution. Unfortunately, I'm not adding that back. But if he would have had a business broker or somebody that wasn't aware and had put that as a personal expense, and you don't dig in further and ask for documentation behind that, you may take that as an add back, but you're not going to see that when you flip management on that. So discretionary expenses, those are definitely things to be looking for. A lot of it comes down to asking the questions. Are you paying for cell phone bills that aren't part of the business? Are you paying for your personal car payment, your car insurance, things like that? One-time costs on the P&L, those I deem things that would not need to be done again for 5 or more years. So as an example, if the owner put a new roof on their building and didn't capitalize that on the balance sheet, they actually expensed it in the P&L, that would be a one-time cost. I would add that back, because you're not replacing your roof every year. It's not a reoccurring expense. One-time costs can be subjective. I had a print shop that replaced a print head. It was like $5,000. He said in the 20 years he owned the shop, he had never replaced it before. So we had it as an add back. But when a buyer looked at it, he was like, well, that's really the cost of doing business, because that's a piece of machinery you have to keep up. So again, they're subjective. You may think it's an add back or they may not, and vice versa, but it's all about asking questions. Another area of normalizing the financials, or the P&L specifically, is looking at a fair market wage and a fair market rent. A lot of the times we see the owners taking out a super high salary, and when it comes to a replacement cost, it could be half. I mean, that's very common. So that, again, is about asking the questions. If you had to hire a replacement for yourself tomorrow, what would you pay them? Also thinking of it, depending on how you plan to operate the business, what would you pay a replacement to come in and take over what they're doing? Or if you're coming in to operate, you may not need to take out a salary for yourself if you take it out as a distribution. So those are all thoughts around fair market wages that you want to kind of have in the back of your head. Fair market rent, I do see quite often that there is a lot of rent payments that are below fair market. So something you want to be aware of is the lease assumable if they lease it? Can I get that same rate? Because if I can't, then I need to increase that rate and adjust the EBITDA that way. If you're purchasing it, obviously that's going to be a different story, because you're going to want to make adjustments to the P&L depending on if you're keeping the real estate in the company or if you're going to take it out into a separate LLC. So those are all things to normalize the profit and loss statement. I don't ever make any adjustments above net income when I get the financials from a seller. Now, there are some caveats to that. Depending on how they run their cost of goods, a lot of the times I do see that they are not including items that need to be up in COGS, and it's down in the SG&A. So when we're benchmarking, that would be why that's important, because moving it from SG&A up into that cost of goods sold isn't going to change the dollar numbers, but it's going to change your gross margin. Anytime it is a management discretionary expense, like donating to the local soccer team or to church or something like that, as long as sales are not tied to those donations, so they're not using it as advertising to get business, those adjustments can be added back as well. And then gain loss on disposal of assets, that can be added or adjusted depending on, because you may not have sold that asset while they did. So it's just management discretionary at that point. And then obviously, once we get that normalized net income, we're going to make the traditional EBITDA adjustments, interest expense, depreciation, amortization, if there is any, and then any business income taxes paid. So then that gets us to that normalized EBITDA number. Okay, so looking at the balance sheet, there are a few areas where you're going to want to make some adjustments on the balance sheet. I do find that a lot of times the balance sheet is just kind of taken as is and not really normalized. But when you actually look at it, there's probably quite a few things that you can make adjustments on. One of them would be obsolete inventory. So if you do a preliminary benchmark of inventory on the balance sheet without any adjustments, and you see that it's very high compared to the industry, then I would dig in a little further and start asking the seller, how often are you counting your inventory? Do you know of obsolete inventory that's sitting on your books? A lot of the times they're aware there's obsolete inventory there. And really for your purposes, if it's obsolete, get it off the books. You're not going to be able to sell it either. So let's just have them write it off as bad debt and clear it off their books. Non-operational assets. This is really a big one, especially when owners or sellers are keeping a truck. I've seen someone keep a lawnmower, just interesting things that they are sentimental about and want to hold on to, but they're sitting in the asset side of that balance sheet. So on the right-hand side here, I have a couple notes. I have a boat, which, I mean, there was literally no dollar value on that one, but still, it's a non-operating asset. A second boat he had that was $80,000 that he's keeping, we took off the books. And then his Honda Accord, they were keeping that as well. So with taking the assets off, we also have to take off any depreciation that is associated with those assets so that we're not overstating the depreciation. A third part to look at with fixed assets is there also a loan or a note payable for that asset? In this instance, that Regal boat purchase of the $80,000, it did have a corresponding note that then I needed to go on the liabilities and take that off as well. And then the other thing is, once you make all your adjustments, if any, I like to go back and make one big adjustment to retained earnings so that the balance sheet balances again. So the assets and then the liability and equity equal each other. You don't have to, but some of the ratios that you calculate for the benchmarking does utilize retained earnings. And so for that purpose, you would want to rebalance it and then use the normalized amounts when you're benchmarking. Let's look at an industry review. So I always start doing my financial input first. So I have some ideas of what I'm looking at with the company. And then I like to pull the industry report. I use IBIS World. There is a a handful of other industry reports that I've used, I find IBIS to be the most comprehensive. They are a bit on the pricier side than everyone else, which is unfortunate, but they have awesome information, and they do a 5-year outlook. So it's not just what's been going on, it's what are they expecting. They have also this year included quite a bit of info about COVID and how that has been affecting the industry. So that has been super helpful too. Yes.
I wanted to just interject, Amy, that our search funder members have access to IBIS World Reports. We entered into a partnership agreement, a very pricey one, for our searchers. So our searchers do have access to it now.
Oh my gosh, you guys are amazing. I love IBIS World, so that is an awesome benefit for you guys. So take advantage of it and read your industry reports from IBIS. So, Karen, that's awesome. Thank you. Okay, so this is what I really go through and look at. I'll read pretty much the entire industry report. Some of them can be 35 pages. If you get the summary one, they're about 5, but they still touch on all the really important information. So like I said, it gives you an industry outlook. It does a 5-year outlook. They do a SWOT analysis. They look at the different products and markets that are going on in your industry, what the competitive landscape looks like. It does give you benchmarking statistics, and then it also tells you who the major players are. So I will give you a little caveat on the benchmarking statistics in IBIS World. So I also pull the RMA statistics. That is pretty much like the banking gold standard is RMA statistics. And IBIS World also utilizes the RMA statistics, but they don't match. So, and I've asked IBIS, and I don't know what the difference is. It's that my guess is that they're using a different number of financial statements. So maybe RMA uses 150 financial statements to get their statistics, and then IBIS maybe uses 50 of them. I don't know. That's the only plausible explanation I have. So if you have access to both, I would look at both, because I do. And it just gives you a guideline of, okay, if we're not falling in here, but we are on RMA, it just gives you more insight to see both and what questions can you ask. The other nice thing about the major players section in here is that when you're looking for public comps, this is a really great place to start because it usually, depending on the industry, will give you a listing of a handful of businesses in that sector. Because I know a lot of like Yahoo Finance and Google Finance and all that took away a lot of the analytics on it, so you don't get it anymore. And it's hard to just Google public company because it doesn't work. I've tried it. So that's always a great place to start. Okay, so benchmarking. This is always a fun place to start. So IBIS World has a cost structure comparison, which is what we're looking at on the screen. So what I do is I take the trailing 12 months, or some people call it the last 12 months of the financials, and I pull over the sections for these 6 different areas. And then I compare it to the industry. This is really like your 50,000 foot view of what is going on in the industry. And if we're seeing areas that are really different from one another, that's where we're going to start digging in and asking questions. This really doesn't tell us a whole lot other than giving you a starting place to ask deeper questions of the management team. So this one, for instance, they have purchases of 35%, but the industry is at 42%. So I want to go back to that management team and ask, how are you able to get your supplies, your purchases, so much below the industry average? So do you have contracts in place with those suppliers? Do you have, is he your neighbor and he just gives you a really good deal? Because that could mean when you take over or your team takes over, that deal is gone and it's going to go back up, which then adjusts all of your cost and your margins. So that would be my biggest point here. If there's discrepancies, it's, again, starting place to ask questions. This benchmark analysis is a bit more rigorous, looking at different operating ratios, liquidity, management efficiency, and leverage. I will say that if you can benchmark, or if you make adjustments to your balance sheet, because that's where a lot of these are coming from, if you can normalize all the year ends that they give you, that would be the ideal situation. However, with some assets, not knowing when they got sold and stuff like that, you might not have all that information. So at least normalizing the last year end that you have is going to give you the biggest indication of where the company is now. But then make sure when you're actually calculating these ratios, you're using the normalized numbers that you came up with. I did that on accident once where I normalized it, but then I didn't even use the normalized numbers. I'm like, these ratios look wrong. And yeah, it was just my error. IBIS does calculate a lot more of ratios than I'm showing on here. I tend to only look at what really makes sense for the business. I had an HR consultancy company that operated out of 1,000 square foot office. Their assets consisted of a computer and a desk chair. So they were very asset light. So looking at profit before taxes to total assets makes no sense. It's irrelevant. We don't care. They're not selling anything that their chair made money from. So just keep that in mind too. Just because we have access to calculate all of these ratios, they don't always make sense to look at. I will say a huge ratio that is probably the most highly negotiated part of a transaction is this next one we're going to look at, which is working capital. So I actually had an accountant, a CPA who had done transactions before, flat out told me he had no idea what working capital was. And having him be a CPA, that kind of shocked me. Now, if you don't know what working capital is, that's totally fine. But for his profession, he should have known what it was and wasn't a great negotiator on working capital. So the technical calculation for working capital is your current assets minus your current liabilities. Now, that seems pretty straightforward. However, that does get complicated when we look at certain companies. How we run all of our deals is a cash-free, debt-free basis. So any cash sitting in the bank account, not tied to customer deposits or payroll that's due, would stay with the seller. And then they would also pay off any long-term liabilities that are sitting on the balance sheet.
Some deals that we've done in healthcare, could you negotiate for the sellers to give you working capital for day one, at 3 to 6 months working capital for day one from the actual account of the business and not get it from the bank?
Oh, absolutely. So one of the reasons working capital is so highly negotiated is because you as the buyer, day one, don't want to have to turn around and get another line of credit to be able to fund your business. Like, I just dropped a couple $1 million on this business and now I got to go get another loan. That doesn't make sense. So absolutely, you would want to negotiate working capital with them to leave whatever the peg or negotiated number is in the business so you have continuity and can continue running it. One
more thing, I'm sorry. Is there a way, some sellers that I've tried to structure the deal that way, they were reluctant to, give us working capital. Is there a way to, I guess, convince the seller to, leaving at least 90 day, for day one operations? Is there a way to, get around that if the seller is kind of reluctant?
What's the revenue size of these companies that you had done this with?
Well, we're, just to give you a bit of background, I'm sorry, everyone, but just to give you a bit of background, we're actually an investment group and we're doing a consolidation in the clinical research organization industry. So this is healthcare. We're looking at companies, 2 million in EBITDA to 10 million in EBITDA. We're paying anywhere between, 1.5 to 5 times earnings. But candidly, it's been more so, 3.5 to 4.8, 4.3, 4 times, 4.3, 4.8 times earnings that we've been, seeing. But the prices are about from 2.5 million to 8 million.
So that actually surprises me then that you're asking or telling me that sellers are reluctant to leave that much working capital in, because I generally see that in the smaller mom and pop shops where they're like, why they don't understand it. Whereas with the companies that you're dealing with are, I would assume, are a bit more sophisticated and have advisors around them that would be able to explain to them how this works. So if you can show the business or the owners that you need a 90-day turnaround on working capital to keep the business cash flowing, I don't see how you can refute that. But that kind of, let me marinate on that one for a little bit. And maybe I'll shoot you an email after and we can talk a little bit more in detail. So going back to working capital, a lot of the times there are things in working capital, either the asset side or the liabilities, that a seller is going to argue with you should be included when really they're just trying to get more money out of the business and have you pay for things, which I hate to say that, but it's true. One thing in particular, if there is a line of credit that the business has, if they're using it to buy equipment, that is not a working capital liability. That should be a note payable. They're just utilizing a different way to finance the equipment, and that would not be included in the working capital calculation. Other things like in current assets, you could look at if they have, accounts receivables that are past 120 days. You could ask them to give you their AR report and actually calculate what it should be, taking out those super past due AR. Again, that depends on the industry that you're looking at, because if it is very typical for them to hold AR that long, then you can't really make the adjustment for it. But if it's atypical, then definitely you can adjust that. Like I said, working capital is super negotiated in every deal that I've ever seen. And it really comes down to, what are we including in the assets? What are we including in the liabilities? And does it really need to be there? Other things to look at, is it seasonal? Do we see a huge fluctuation? Because if you have a seasonal business and you're closing in the down season, working capital is going to be really low. But if you have a month before you start to pick back up, you're going to want more working capital left in there so you can ramp up and be ready for that busy season. Now, on the flip side of that, if you close in a busy season and working capital is really high, the business owner is going to say, well, our season's going to be done next month, so we're going to drop right back down. So you should give me all of that working capital. So that's where it starts to get the back and forth between who's right, who's wrong. And really, we end up usually somewhere in the middle. So don't feel like you're totally giving in if you allow them to take a little bit more of the working capital, as long as you can continue to maintain the business without having to go and take out that secondary loan. Looking at some comps analysis. So like I mentioned earlier, you can look at public comps and private comps. Private comps are predominantly what you're going to use to come up with your multiples. The public comps, what you're looking for on those is looking at what is their beta, because you're going to utilize that in the weighted average cost of capital, or the WACC calculation, if you do DCF, or capitalization of earnings, as well as the debt to equity. And then you can also do a price to earnings valuation method if it makes sense for your company. I'm going to run you through kind of how I pull my comps. So first of all, I'm looking at what is the NAICS code, what industry are they operating in? Obviously, we need to get as close to what the business is doing as possible. Then what I typically do is I take their top line revenue and I take 50% above that and 50% below that to start looking at my grouping of comps. For let's just say a bar or restaurant, there are hundreds of thousands of comps. And if 50% above and below is too many, if you get like 300 comps in that, then I start narrowing it down and getting a really close, tight knit group of comps. Because one, I don't want to sort through 300 comps, and we're going to do a little more after that. Once you have a pretty good grouping of that, I look at then the EBITDA multiples or SDE if you're a smaller business, and I kick out if we have outliers. If I'm looking at a restaurant and I see a 10 times EBITDA, yeah, I'm thinking that's a total outlier, or their EBITDA is negative. That could be why they got such a high multiple, but that's not going to be a really good statistic for you if it's way out of the norm. The other thing we want to talk about is if you're going to use a weighted average. So typically when I'm doing valuations for sell-side clients, I do a weighted average over the time periods that they give me for financials. Usually I get 3 full years and then a trailing 12 months. I generally put the most weight on the trailing 12 months because it's the biggest indication of what the business is going to do going forward. Now that can vary though. We had a client that we're selling right now. They had a year last year where they had about $250,000 in EBITDA, whereas the year before it was $1.4 million. And what happened, they're in construction, they expensed all their supplies and finished the jobs in 19, but the revenue they earned got pushed into 20. So it looks horrible. And you can't put a multiple on $200,000 when their EBITDA really should be 1.2 million. So we had to go and tell the story to our potential buyers of, this is what happened. It really doesn't look as bad as it is. And you should put more weighting on 18 than 19 and the TTM. So just because you see a dip maybe in EBITDA or you see a spike in EBITDA, that's where you want to ask some questions and then make an appropriate adjustment if you're going to do a weighted average. You don't have to do a weighted average either. You could put 100% of your multiplier on the most recent year. I've seen some buyers do that too. There's nothing that says you can't do that.
Real quick, are you evaluating these businesses with the real estate together? And if you are, does that not skew the numbers of the business itself?
So the real estate, it depends on if the real estate is held in the same entity or if it is held in a separate LLC. So if it's held in a separate LLC and they pay rent to that LLC, there's going to be a fair market rent adjustment on the P&L. And then what we would do is, again, it depends on if the buyer is going to buy the real estate or if they're going to lease it. If the rent or if the entity is held within,
we would lease it.
You would lease it, then we wouldn't make any adjustments whatsoever. If there's a fair market rent in there for what you would consider paying for the lease, then that's already taken into consideration and no additional adjustments need to be made.
And one more question pertaining to that. If there's a, hypothetically speaking, a hyperbaric chamber that has 15 rooms and it's, the doctor only has 6 rooms occupied,
okay,
but we don't want to buy the real estate, right? So would we pay for the entire sum of for the entire 12, 15 rooms, or would we pay based on the occupancy rate?
That's a tricky one that you're going to end up negotiating. My my assumption would be they're going to push for you to pay for 100% of the space that you would for the whole space. Now I see coming from your side, if I'm only going to occupy 50% of that, then I want to only pay for 50% of that. But then that comes down to, can they section off the other 50% and have another lease on that other side? Is that an option? We're going to...
Amy, sorry.
Yep.
Sorry, can I ask just a quick question regarding the public market comparables you were mentioning?
Yeah.
And I'm just wondering if you're going to use the data to have a beta and arrive at a discount rate. I'm just wondering, given that in this part of the market where you're looking at really small companies that are private companies, do you make any adjustments to the discount rate to do a discounted cash flow by, let's say, an illiquidity premium, a small cap premium, or some other type of premiums? And what source of data do you use to get something that's reasonable or acceptable as a standard practice?
Yes, so I would make on the WAC, which I don't think I put into this presentation, I would make a small cap adjustment. So Duff and Phelps has their cost of capital navigator software. Unfortunately, when they moved it to the software, you now have to pay for the decile breakdowns that gives you the number for the small cap premiums. If you Google around and look for Ibbotson's company decile chart, you can find one from like 17 or 18, where it says the 10th decile is about an 11.5% premium that you would add.
Wow. Okay.
The smallest decile, the market cap though, is 250 million. So it's still a huge category for the smallest discount. But yes, so you can Google around for that, or you can look at the Duff and Phelps. They do put out public accessible information periodically as well. But that's really where I'm looking when I pull that.
Thank you.
Yeah, you're welcome. Okay, so fair market value, when you're looking at your comps and you're getting multiples of EBITDA, revenue, gross profit, all that great stuff, that, you can multiply by your EBITDA number that you normalized, and it'll give you a value. But we also want to take into consideration any company risk factors that we need to bump the multiple potentially down or even up. Risk factors that I see: does the business owner run the business? Is he everything? Does he do the hiring, the firing, the sales, the repairs? So, if he is the business, that is a huge risk factor when you take over, because that transfer of knowledge is not necessarily smooth, and customers may not like you, but they liked him, and so they leave. That happens. It would be ideal for them to have a management team in place. Other company risk factors: customer concentration, which probably isn't new to any of you guys. But if they have one customer that's 75% of their revenue every year, that's a huge red flag. I do have a construction company right now, a different one, that their customer concentration is 80% every year. But each year, it's a different general contractor that they are working with. So I have a story behind why my customer concentration is so high. It's just because that general contractor, they won the bids for that guy that year. The next year, it'll be a different general contractor. So again, ask questions of what's up with your customer concentration. I generally say anybody over 15%, that's one customer, then you want to start asking questions. That's a risk factor. Other things to think about, do you have contracts in place with your customers? Do you have a vendor concentration issue? Things of that nature. The weighted averages we discussed already. The different valuation methods, I believe I have it on the next slide. Then I talked about cash-free, debt-free sale, and then the working capital. One other thing with that, if you're not familiar, working capital that there is included in the sale of the business. However, let's say we peg the working capital at $100,000. So on the day of closing, we do a working capital adjustment, and let's say it comes out to $120,000. Well, in that case, the buyer would owe the seller $20,000 to bring it back to $100,000, which is the agreed upon peg. Now, in the opposite situation, if we do the closing working capital and it's only $80,000, the seller will pay in the $20,000 to get it up to that $100,000 peg. So that's kind of different. It's a dollar for dollar adjustment at closing to the peg, whereas it's not a multiple like we use the EBITDA on. Another big thing is accounting consideration. So if you look at their financials and they are a complete mess, that is risky. That's just giving you more work. You're going to have to hire a better accountant. That's money. And it takes a lot of time to get that stuff fixed. So depending on if they're just management internal financials, like that would be the bottom of the barrel. Then we have compiled, which you have a CPA, they're putting stuff in for you, but they're not doing anything else. Reviewed and audited are a lot more ideal. Obviously, audited would be amazing. You know that they have a third party checking that they're accurate. Reviewed, I see quite often that buyers are like, awesome, they're reviewed. I don't need to do a crazy quality of earnings because I'm confident that the CPA has done their job and reviewed them correctly.
Sorry, what's the difference between reviewed and audited?
So reviewed is where you actually have not, so I'm the company's CPA. I every year go in, I do their journal entries, I maybe do their year-end taxes. I do a couple samplings to make sure that, the AR and the AP is correct, the inventory has been counted and it's in the books correctly. That would be reviewed. Now, if I have company audited statements, that means a different CPA, not their regular CPA, is coming in and doing a rigorous analysis to make sure that it checks and balances, and that where the cash is saying it is on the actual bank statement shows in the general ledger and flows through everything properly. So it's a third party totally coming in and auditing it. Yep.
Got it. Thank you.
And I'm almost done talking about stuff. Sorry, this took longer than I thought.
It's been absolutely incredible. And I've learned a lot, and this has been very helpful. And I appreciate your taking the time to be clear, particularly since I'm worse than that CPA that you talked about. So I appreciate it.
Yeah. Okay, so going back to our private comps that we're pulling, this is where we're getting revenue or multiples as revenue, gross profit, EBITDA, and SDE. If you don't know, SDE is seller's discretionary earnings. That would be where you do not put in a comp for a replacement for the owner. You would add the owner's entire salary back, and then you do not make a fair market adjustment for a comp. And basically, we see it a lot in the really smaller businesses where I'm coming out of corporate America and I want to buy a new job and I'm going to run the company and everything flows to me at the end of the day. For you guys, it's probably not going to happen. It's going to be an EBITDA multiple, but I put it in there just in case. I use deal stats for finding my private comps. They have probably one of the larger databases. It is a paid subscription. It's not too terribly expensive. You can find, PitchBook, I do have that as well. I'm not a super fan of PitchBook for finding multiples because they're not always in there. A lot of companies don't disclose that, so they don't get put in there. There is also peer comps. Again, that is a subscription, but the last time I paid for peer comps, it is a lot significantly cheaper than deal stats. The difference between those two, though, is that peer comps is strictly deals that were financed by SBA loans. So those tend to be on the smaller side. I would say probably one of the bigger ones that I saw in there was a little over 5 million, because, the large end of SBA loans is 5 million. So that is where you can find some of the private comp data. SDE and EBITDA, where does one stop and one start? It's kind of a gray area. I usually say that if the company is doing less than 2 million in sales, that I'm going to look at an SDE multiple. And what I say it depends on who the buyer is. If you are, like I said, coming out of corporate America, I'm going to buy my next job and run this company, it's really going to look more like SDE. But if you are coming in as a buyer, you are going to replace them and put a new manager in there, and you're kind of going to manage from afar, then you're going to be EBITDA. So I hope that makes sense. Right there, that's 4 multiples we could look at. But when does it make sense to look at them? Revenue, you're really only ever going to put consideration on that if it is a reoccurring revenue business. So my construction company example, they are very transactional. Every year they have to bid for jobs. When the job is done, they're gone. They are not reoccurring revenue. They would not trade on a multiple of revenue. Now, if I'm Netflix and I'm subscription based and every month I have 15 million subscribers paying me $14, you can pretty much say I'm guaranteed this revenue month after month. That would trade on a multiple of revenue. You could look at it that way. A multiple of gross profit, again, you're not seeing it a whole lot. You might see it further down as you have more companies under your belt and you're starting to build a platform where you would then start acquiring tuck-ins or add-ons. If you have a manufacturing platform and you have an add-on or a tuck-in, you could look at all the SG&A below gross profit. You don't need accounting. You already have that. You wouldn't need, some of the office type personnel. Could you get rid of those? So there is a point where you're going to look at, I'm buying your customer list and who you're selling to, and I will take that revenue and then that cost of goods, and then all the rest is going to be absorbed by my company already. It's not another expense. That would be where you would look at a multiple of gross profit. EBITDA is the most commonly employed multiple metric. Pretty much everybody is going to look at a multiple of EBITDA. Just make sure you normalize your financials first. Otherwise, you may be missing things, either good or bad in the situation. Then we have capitalization of earnings and discounted cash flow. Now, we tend to tell buyers or sellers that the more sophisticated buyers, such as you guys, search funders, private equity groups, family offices, they are doing these advanced methods of valuation, which you have to build up your weighted average cost of capital, which is that bottom section there, to come up with your cap rate and your discount rate. I do give a little caveat on discounted cash flow of how accurate is your pro forma that your forecast that you're putting together. If it is not reasonable or accurate, or you say, I'm going to do 10% next year and just go 10% increase down the whole P&L, I wouldn't even bother using a DCF. Because it's not really giving you any additional value. You're going to come up with the same or a very close number to your EBITDA multiple. So if you do a rigorous analysis and you're thinking, okay, I'm going to add this second product line, and this is where I think sales are going to go from adding that, and you can get a reasonable adjustment for expenses. Now that would be somewhere where I would say, it would be valuable to do a DCF method because you're adding something into the company that was not there already. But if they're just kind of trucking along, doing the same thing they've always been doing, maybe a 2% increase. Like, it's not going to tell you anything different. Not to say you can't still do it, but it just might not be as valuable. Okay, so the weighted average cost of capital, this we kind of touched on when we said, if the company is much smaller than your public comps, are you going to put a premium in there to adjust for that? So there's a couple parts where you can do that. That would be that sub-micro cap conversion. That would be that small adjustment there. Or you could put it in business-specific risk. It really doesn't make a difference because they all get added up together anyway, but don't double dip. So if you put it in sub-micro cap conversion, do not put a size adjustment in your business-specific risk. Things in business-specific risk you're going to put in there are if they don't have a management team, if they have high customer concentration, if they don't have contracts with their customers, areas where you think is vulnerable, especially if you come in and a customer leaves. That would be that business-specific risk. The other thing kind of to touch on this one is the interest rate of debt. They should be clearing all the debt on a cash-free, debt-free basis when you buy it. So the interest rate I would put in there is what you are getting for your interest rate if you are utilizing a loan to pay for the business, because then it's more specific to you and how you are going to operate the company. My 20-minute presentation went a lot further. Sorry, guys. But I hope you got a lot out of this. I do see one other question on here. My opinion on the SDE versus EBITDA. You, as a sophisticated buyer, will have the dexterity to flip back and forth between the adjustments to understand these two to judge the business. That is absolutely true. You definitely can look at it both ways. Since you are going to be owning the business anyway, technically all of that is going to flow to the bottom for you. It's just, do you have to have that replacement in there?
So, Amy, I have a few questions for you.
Yeah.
And that is for folks who are thinking about hiring a person to do their business valuation. The first question would be, when is the time to do that? When is the time to hire someone like you? And then what sort of professional standards or certifications or organizations should that person be in, or should they be looking for in hiring someone?
Yes. So I'm going to address the second question first. So when you're looking for a evaluator, two of the most commonly known ones are the CVA, which is what I have, a certified valuation analyst. That is through NACFA. And then also ABV is another very common one, and it eludes me to what it stands for, Accredited Business Valuator, I believe. It used to be that your CPA could do a certified valuation for you, but that has changed in the SBA world. So an SBA loan would not allow just any CPA to submit the certification. Now, for what you guys are doing, you don't need a certified valuation. Basically, the difference between having just a fair market value done for you and a certified valuation is the 75-page report that comes with it, and then the assumed risk that the valuator takes saying it's certified. So what I would look for is somebody that's going to be, touching on all those different things we said at the beginning of it. Now, when to start looking at companies with evaluator, that is really dependent on your comfortability, if that's a word, with running the numbers and submitting an IOI. We do see a lot of times that buyers, they get the financials, they do their original analysis, maybe they ask a handful of questions, and they come up with what they feel is a reasonable range. And they'll submit an indication of interest saying, here's the range I'm looking at. We will bring those back to our clients and say, here's what they are. Do we want to keep going forward with that? So if you are comfortable getting that far, I would say I would hold off hiring a evaluator until you're ready to submit an LOI with a more firm number that then you go exclusive. If you are not as comfortable doing that upfront work and the analysis with benchmarking and things like that, I would say bring somebody in sooner. But then maybe I would call it like a valuation light, because you don't have all the questions answered yet because you're just not that far with the seller. So it wouldn't be as rigorous for them to do it in the earlier stages.
So my next question is, do you feel that when someone hires someone to do a business valuation, that search fund experience is helpful, necessary, or unnecessary?
Are you asking if the evaluator has that? I'm sorry.
If the evaluator has that.
Oh, yeah. I don't think it matters at all. No.
Okay.
We're a third party unbiased opinion, and no, I don't think that matters at all.
Okay, great.
Now Rob wants to know, do you use different multiples for EBITDA versus SDE? For example, if we're typically using a 3 to 5x for EBITDA, is there a different range of multiples for SDE? I'm looking at a company that is just under 2 million in SDE and the EBITDA is around 1 million. The seller is using the SDE number and applying the EBITDA multiple.
Well, of course, because that's going to give them a higher value. Yeah, there usually is a difference in multiples between SDE and EBITDA. It's now called Deal Stats. Deal Stats, PitchBook, PitchBook and peer comps will distinguish between the two. So I would make sure that is something you are watching, because in this instance, SDE is usually a lower multiple, because it's an increased number when you're adding back that salary. So if they're applying EBITDA multiple to SDE, it's going to overstate the value.
Next question from Lori is, how would you benchmark how much to take off for things like high customer concentration?
So if you ever hear evaluators say valuations are part art and part science, this is the art part of it. Looking at business risk, any of them, there's no hard and fast number to say, yep, I'm going to take 5% for customer concentration in my WACC calculation, or there's nothing to say like, okay, I'll take off a quarter on the EBITDA number. So it is really, it comes down to kind of a gut feeling of this is where the business should land. It's a lot easier to take that into consideration on the WACC when we're looking at companies that are doing revenue between, let's say, 5 and 30 million. Your overall discount rate could end up between 20 and 35%. So it's kind of, you know the rules of thumb, and then apply that and adjust as you feel it makes sense. So like I said, not like a certain number and then you take off 70% or anything like that, unfortunately.
Thank you. Mark?
So the next question comes from Jim Watson. How do you think about post-COVID revenue trends? For example, what if a company jumps up in revenue in the early months of COVID, but then comes back down? Feels like a 12-month view may not make sense rather than to guesstimate what it would look like going forward.
Yeah, COVID has definitely been a tricky thing for what's going on with all of these business valuations this year. And part of that will come into maybe this is where we do a DCF, because if they take a really big dip in COVID this year for COVID, when do we think we're going to start seeing that trend back up to where they normal out again? Unfortunately, there has not been any one great recommendation as to what valuators are doing with COVID times and with revenues jumping, it's very situational. And where do we think the business is going? And how much is it affected by the industry getting shut down? It's so situational in that case. I'm sorry, I can't give you a better answer.
Next question. So this is from, I hope I'm pronouncing the name correctly, Jigar. The question is, what is the cost range for business valuation services? I assume it's based on the business type, the business size, etc.
So the way that we price our services for our sellers is it is tiered based on their overall revenue. I would say, I believe we had talked for the search funder group that we were looking at a price around $2,500 to do the valuation for you. And that's on our low side because we wanted to be able to help you guys do stuff, and do realize that not all of you are cash flowing yet. So we wanted to make it, something that could be reasonable for you. If you get a quote for a certified valuation, just so if you guys shop, that you guys have an idea, I would say upwards of $5,000 to $7,500, $5,000 to $7,500. So just make sure, you don't necessarily need one for what you guys are doing. So don't pay for one if you don't have to.
Awesome.
Thank you, Amy. And I really want to thank Blue Sky Business Resources for their support for the search funder community by offering such generous terms. Thank you.
Yeah, totally.
So with respect to real estate and property, how would you include that in a valuation? For example, for a winery, would you estimate the business itself and then try to do comps on the land or property value to add it back in?
That's a good one. I have done a couple valuations for wineries. If they are growing the grapes and that is part of the business sale, the land is not on top of the business price. It'd be just like a construction company. You don't get your assets on top of the business value. Everything that makes the business operable or profitable goes with the business. Now, if it were the case where it was a winery, I was going to say, if it's just the building and they're processing it there, that'd be a different story. I would sell the land separately, but most cases, I'm going to say that the land would go with it as part of the overall value.
Next question from Jay. You typically work with sellers. What is your best negotiating advice for us buyers? And Jay also thanks you and says what a great job you did on the presentation.
Well, thank you. So as a buyer, I would ask a lot of questions. I would literally question every add back, unless it's like a straight, hey, this is their depreciation they're adding back. Clearly, we know why we're adding that back. But if it's personal expenses, I would ask what they are to make sure that they are truly non-operating expenses. I would ask, do you have a management team in place? What does your customer concentration look like? Why are you exiting the business? I mean, a lot of the times you get, I'm retiring, but sometimes they're like, I'm burnt out. Like, I don't want to do this anymore. Well, why? What's going on that you now don't like your job? Which it could just be, I've been here too long. But sometimes there's stuff behind the curtains that come out in due diligence. And then you guys are like, this sucks. Like, why did I get into this? We do tell all of our our clients that if there is some sort of like green hair on the business, get out in front of it first. Don't let that come out in due diligence, because that just makes everybody else more irritable. Negotiating gets harder and it's not fun. So I would say ask a lot of questions up front. Even if you feel they're intrusive, you're trying to buy this business and make a living from this. So you need to be asking the tough questions.
So, Amy, we've gone a little long. I want to thank you for your time today. This was wonderful. I hope we can have you back again for other topics in this area because it was just terrific, and really want to applaud you. I want to thank everyone who was able to attend today, and so many people stayed on late, and really appreciate that. Again, just wonderful, and happy to have you as a partner with us on searchfunder.com. Thank you.
No, thank you for having me. And I will definitely come on and we can chat some more.